Josh Vecchio here, mortgage broker with Hunter Galloway, the home for home buyers across Australia. And today we look at the All Monies Clause and how this can have a devastating impact on you. So keep watching. And before we jump in, please remember that this is general advice only, and it doesn't take into consideration your financial position. So it's best to seek the services of a legal professional to understand how these concepts apply to your unique situation. 1. What is the All Monies Clause? Well, it's a condition included in the lender's memorandum of provisions, essentially the terms and conditions which allows for all debts owed by the borrower to be secured against the property held by the lender. So if you're looking to buy a home for $500,000 and need a loan of $300,000, the bank holds a right over the property to secure the mortgage. And in the event you default, repossession is allowed. And that makes sense. But under the All Monies Clause, it also stipulates that debt owed by you, the borrower, to the bank also includes not only the mortgage, but other debts to the lender. So this includes such things as credit cards and personal loans. Let's take a look at how the wording of this clause actually appears in the bank loan contracts. At any time, all monies which is owed by one or more of you, the borrowers, owed us, the lender, or will or may owe us in the future. So as we can see here, it's very clear that the lender is not only covering the debt for the mortgage, but also anything else borrowed both now or in the future, whether it be the mortgage or otherwise. Why this is important is because of a conversation I had over the barbecue some time ago, which prompted me to think about this very topic. The person I was talking to was sharing their father's bulletproof retirement plan, which he had methodically devised over many years and over many beers. His plan was to gather as many credit cards as he could, getting the biggest credit limit possible. You see, once he retired, he was gonna bro down.
Start up, cash in, sell out, bro down.
Taking all the credit cards to the limit, living free and large. But what he hadn't considered is that the lender still holds a right over his property, and I'm sure if he had received the proper advice from a financial planner, would have suggested a more proven plan.
Do you want more money? I know I do.
Oh, and by the way, remember to hit that subscribe button below to keep up to date with all things property and finance. 2. How does this work? So let's take a look at how this works in the real world. Let's look at Jane, who has a mortgage with the bank for $300,000. She bought her property for $600,000 and the bank valued it the same. Her loan to value ratio is 50%. Jane, 6 months later, gets herself a personal loan with the same bank for $80,000. For whatever reason, Jane, a little while later, finds herself in a little bit of hot water. Unable to make the repayments, the bank repossesses her property. When they do this, not only do they clear the home loan of $300,000, but also the personal loan of $80,000. Whilst the car loan wasn't secured against the home, under the All Monies Clause, it's effectively included in the sales proceeds. So far so good. Well, let's deep dive into the complexities. 3. Standalone versus cross securitization. So as you build your property portfolio, understanding the All Monies Clause is vital, as will dictate, based on your risk appetite, your financial structure. So if you're an investor and have multiple properties, you will have some important decisions to make. The first is whether to cross secure your properties or have them stand alone. Before looking at how the All Monies Clause applies to these scenarios, let's take a look at the difference between the two. Firstly, standalone is a term described when a property stands on its own 2 feet. So if you have a home worth $100,000 and a loan against it of $80,000, the loan is secured by one and the same. With the loan to value ratio being 80%, we can see that it's solely self-reliant. You could do this multiple times and you will receive the same result. The property and its debt is secured by itself. No help is needed. Cross securitization is much different, and essentially means that the debt is secured by multiple properties. So rather than having the debt secured and committed to one home, it's promiscuous and isn't happy unless it's tied to multiple. Who knew debt could be so devious? So considering the same situation, the debt remains the same at $80,000, but it's secured by 2 properties, valued at $50,000 each, or in total $100,000. And like before, the loan to value ratio would remain at 80%, with the main difference that the debt is secured by 2 properties rather than 1. Okay, great. Now we understand the difference between cross securitization and standalone. So the question becomes, why would you choose one over the other? Well, off the bat, cross securitization is achieved by you having all your lendings with one provider. What I've seen in the past is that if you go directly to the bank, it's more likely that you'll be given this option. And this is for a variety of reasons. Firstly, by doing so, it allows a banker to only complete one application rather than multiple, and it saves them heaps of time. However, this has no benefit for you in them completing their job quicker. Secondly, it's what they're taught by the bank, as it decreases their overall risk as locks you in. Essentially, anytime you're looking to sell or release one of the properties with a cross-securitized application, the other properties associated will only be released providing the bank's valuation permits. So if you're looking to sell and get a bad valuation, well, it might mean the difference between either receiving much less in the way of funds proceeds or even needing to tip in a little bit more money in order to meet the bank's safety lending margins. And just for this point alone, it never makes sense to cross-secure your loans, as it stifles your future plans, even if all your debt is with the same provider, so be warned.
I warned you, but did you listen to me? Oh no, you knew it all, didn't you?
Back to the All Monies Clause. Either structure, whether it's cross-secured or standalone, under the All Monies Clause means that if worse comes to worse and the bank has to repossess, they hold the right to all properties and all debts. The only way around this is to structure standalone applications with different providers. And it's worth noting that you want to avoid having the same banking group. So for example, whilst you might think that a mortgage with Westpac and St. George will achieve this, delving deeper into the ownership, you'll find that they're under the same umbrella, that being the Westpac group, and will mean that you might as well have all your loans with the same provider. A great mortgage broker will help you understand the market and the ownership of the banks accordingly. Therefore, if you are risk adverse, it makes sense having separate providers for your lending portfolio to guard against this All Monies Clause and ensuring that they're all structured as standalone properties. 4. My final thought. The All Monies Clause is useful to know, but not necessarily something to be alarmed at. For those who are looking to build a property empire, a solid foundation is required, and therefore this information will be absolutely invaluable and necessary to mitigate the risks associated with the uncertainties of life, because one never knows what the future entails and therefore can only prepare for the worst and hope for the best. Whilst it's true that trouble comes in twos, it's worth considering that if you are in a position where the bank is exercising their right to repossess, then how you've structured your loan is probably one of the least of your worries. And it could be argued that if you're on the front foot and had taken the appropriate action, that the bank would have never taken such drastic action. But of course, there's always exceptions to the rule, and the banks can flip on a coin without warning, especially if you've amassed a large portfolio with them. As in all things in life, proper prior planning prevents poor performance. So if this is something that will keep you up at night, nothing beats the advice of a professional. A great solicitor and accountant will be key here, and it's highly recommended you seek for their services. And there you have it. Now you know the All Monies Clause and what you can do to avoid the traps associated. What are your thoughts on this clause? I'd love to hear your comment below. Now it's over to you. Are you an investor? Well, did you know here at Hunter Galloway, we help people across Australia? So whether you're looking to refinance, purchase, build, you're in good hands. Simply reach out and call us on 1300 088 065 or visit us online at huntergalloway.com.au. Thanks for watching, and remember to hit that subscribe button below. I'll see you next time.